Several years ago, Dos Equis, the beer brand, ran a most interesting man in the world campaign with a gray-bearded, debonair gentleman who could do no wrong. On today's episode, we're going to ape that same smirky crusade by examining some of the most interesting new ETFs in the world. Now, be forewarned, some of the ETFs mentioned are upstarts and won't necessarily have a 100 million plus asset base. They also won't have the familiar brand power of a Spiders or iShares or Vanguard. Nevertheless, they offer practical solutions for obtaining coverage to overlooked and underserved markets. So, let's begin with the Net Lease Corporate Real Estate ETF. Has ticker symbol NETL, which screens for equity REITs that focus on leasing properties to single tenants under net lease agreements that make tenants responsible for the payment of most, if not all, operating expenses. While most REIT ETFs contain net lease REITs as part of their overall holdings, ticker symbol NETL is a little bit different because it's a pure play on the category. By the way, the triple net lease, where the tenant pays the property taxes, the insurance, and maintenance, is the most common type of net lease. NETL contains 24 holdings with WP Carey, Realty Income Corp., and National Retail Properties among the top 3 holdings. The fund charges 0.60% annually, and the fund's accumulated around $40 million in assets and was introduced in March of 2019. Next up is Home Alone 2, version 2.0. See, the problem with housing ETFs is their tendency to be dominated by heavyweights like Home Depot and Lowe's. So instead of offering balanced exposure to the housing market, it begins to distort. And that's where the Hoya Capital Housing ETF, ticker symbol HOMZ, aims to overcome this problem by making sure that stocks within the segments of the housing market are being tracked and that no single company has too much say. HOMZ's underlying yardstick, the Hoya Capital Housing 100 Index, segregates its 100 stock holdings into 4 areas: home ownership and rental operations, home building and construction, home improvement and furnishings, and home financing technology and services. The home ownership and home building subsectors receive a 30% fixed weighting, while the remaining 2 subsectors are capped at a 20% weighting. Now, the overall effect is a more balanced approach to U.S. housing exposure. U.S. real estate sector represents less than 3% of the S&P 500's exposure, and HOMZ offers a novel solution for getting direct exposure to the housing market portion of it. HOMZ was introduced in March of 2019, and the fund charges 0.45% annually and has amassed around $10 million in assets. Anybody want to be a nerd with a cause? Because if you do, the next ETF might be for you. It's no secret that gaming is one of the biggest trends within the technology sector, and the global gaming craze is expected to grow 9% annually through 2022. The problem is finding a way to get exposure that's concentrated to this trend. Most technology ETFs are way too diversified or dominated by mega caps like Apple and Microsoft. A solution around this is the Roundhill Bitcraft Esports and Digital Entertainment ETF, ticker symbol NERD, which divides its sector exposure into media, hardware, games, and broad-based companies directly related to esports and digital entertainment. NERD owns a cross-section of companies in different sizes, including large, mid, and small caps. Emerging industry groups like esports can be problematic because the universe of companies to choose from is tiny and usually geographically concentrated in just 1 or 2 continents. As such, NERD deliberately takes a global approach, and the fund's largest country exposures are to China, United States, and Japan. NERD was introduced in June of 2019 and has around $11 million in assets. The fund charges annual expenses of 0.25% with a temporary fee waiver that expires in June 2020 that'll increase expenses to 0.5%. And that does it for most interesting ETFs in the world. I'm DeLegge with ETFguide. Thanks for watching.